The Japan carry trade is a financial strategy used by investors and institutions to borrow money in yen, which has ultra-low interest rates, and then invest that capital in assets that offer higher returns in other currencies. Japan's central bank, the Bank of Japan, BOJ, has kept interest rates near zero, or even negative, for more than 2 decades. This long-standing policy has made the Japanese yen a popular funding currency for this trade, with investors capitalizing on the low cost of borrowing. But why is the Japan carry trade so important? Let's break it down. 1. What is the carry trade? At its core, the carry trade is a simple concept. Investors borrow in a currency with a low interest rate, like the yen, and invest those funds in a currency or asset with a higher yield. This strategy relies on the difference in interest rates between 2 countries. The idea is that by borrowing cheaply in Japan, investors can earn more by investing in higher-yielding assets in places like the US or Europe. Japan's interest rates are the lowest in the world, and the BOJ has maintained these policies for a long time to stimulate the economy. The result is that the yen has become the go-to currency for this kind of borrowing. In fact, the Japanese yen is one of the most heavily traded currencies globally, and its role in the carry trade has had a lasting impact on global financial markets. 2. The ripple effect on global markets. The reason we need to pay attention to the Japan carry trade is that it doesn't just affect Japan, it has ripple effects across the entire global economy. When investors borrow large amounts of yen and invest in higher-yielding assets, it floods other markets with capital. This can drive up the prices of stocks, bonds, and commodities, especially in emerging markets where investment flows are particularly sensitive to changes in global liquidity. For example, if investors take out yen loans and invest them in US Treasury bonds, the demand for US assets increases, pushing bond prices up and lowering yields. This can impact US interest rates, and in turn, affect everything from the housing market to corporate investments. Similarly, in emerging markets, where foreign investment can significantly affect asset prices, a surge in capital from the carry trade can cause stock markets to rise rapidly. 3. Currency volatility and risk. The carry trade is also a key driver of currency volatility. When the Bank of Japan signals any changes to its interest rate policy, it can trigger massive shifts in the carry trade. For example, if the BOJ raises interest rates or even hints at doing so, investors might unwind their carry trades. This can lead to a sudden and sharp appreciation of the yen, as investors rush to close their positions and convert yen back into their local currencies. Such a shift can cause significant fluctuations in currency markets, with global currencies like the US dollar, euro, and British pound facing sudden volatility. If you're trading or investing in currencies, these rapid movements can present both risks and opportunities. Understanding the factors behind the carry trade is crucial for predicting market movements and managing currency exposure. 4. Global financial stability and the carry trade. It's not just asset prices and currencies that are affected by the carry trade. The unwind of the carry trade can also impact global financial stability. As capital flows out of one market and into another, it can create imbalances, especially if investors begin to pull their money out of riskier assets. This is particularly important during times of global uncertainty, such as recessions or financial crises. When global liquidity tightens, markets can experience sudden crashes, and the effects can be felt across the world. In 2008, during the global financial crisis, the carry trade unwound rapidly as investors rushed to reduce risk. The yen appreciated dramatically during this period, which exacerbated market instability and contributed to volatility in global asset prices. This is a key reason why investors and financial institutions pay close attention to Japan's monetary policy decisions. If the BOJ signals any tightening of policy, it could lead to significant shifts in market sentiment and trigger a wave of currency and asset price movements. 5. Why investors need to pay attention. As an investor or anyone tracking global financial markets, it's essential to stay informed about the carry trade and the role Japan plays in it. The Bank of Japan's interest rate policy is one of the most important indicators to watch. When the BOJ moves, whether by raising rates or signaling a change in direction, it can have profound effects on global financial markets. For investors managing portfolios, understanding the carry trade helps in assessing risks, especially when dealing with currencies or global assets. For instance, if you're holding US Treasury bonds or emerging market stocks, you need to be aware that changes in Japanese monetary policy could lead to shifts in capital flows that directly impact your investments. Similarly, currency traders should closely watch the BOJ's moves, as a change in Japanese interest rates can lead to sharp reversals in currency pairs involving the yen. Moreover, the carry trade also impacts broader economic factors like inflation and trade balances. When Japanese investors borrow yen and invest abroad, the increased capital flows can influence the prices of goods and services, particularly in countries with high foreign investment. For example, a stronger yen can make Japanese exports more expensive, affecting Japan's trade balance. These factors can all contribute to changes in global economic conditions, and therefore, staying ahead of the carry trade is key to making informed investment decisions. 6. Conclusion. Stay informed, stay ahead. To sum up, the Japan carry trade is not just a financial strategy used by a few savvy investors, it's a major force that affects global financial markets. Whether you're an investor, a trader, or just someone tracking economic trends, understanding the carry trade is crucial for predicting market shifts and managing risk. The carry trade plays a huge role in shaping currency movements, global liquidity, and asset prices. If the Bank of Japan signals a change in its monetary policy, the impact on markets can be far-reaching. As we've seen, a simple change in Japan's interest rates can trigger a wave of volatility, impacting everything from stock markets to commodity prices. So, if you want to stay ahead in the world of finance, make sure you're paying close attention to what's happening in Japan and the carry trade. It could be the key to understanding the next big market move.